Welcome to another episode of A Quest for Twice. Today is November the 8th. There were quite a few companies that reported earnings last week, so I'm going to do a quick review on some of those in my portfolio. The first one is Amazon. Amazon reported very strong sales in the last quarter, which was the fourth quarter in its fiscal year. Its sales were very strong compared to the other three quarters in its fiscal year and up 10% from 1 year ago. Importantly, its adjusted EBIT margin was also very high, came in at 24.1% compared to 21.5% 1 year ago. And if we look at the margins from the other three quarters, we can see that 24.1 is actually the highest margin in the most recent 2 years. Amazon also provided updates on its trailing 3-month underlying orders compared to 1 year ago. For auto solutions, the orders were up 6%, and for commercial and residential solutions, the orders were up 7%. So that those order numbers were not as strong as came out of the recession, but it's still pretty decent compared to the high interest environment and the pressure on the economy. For the strong sales, 6% of the revenue growth actually came from Amazon raising prices. And in its guidance for the upcoming fiscal year, there was like 2% price increase built in its guidance. The underlying sales growth in its guidance was given in a range of 6.5% to 8.5% for the fiscal year. Also, keep in mind that Amazon announced its agreement to sell climate tech in the upcoming fiscal year for $14 billion. That's a multiple of 12.7 EBITDA of $1.1 billion from climate tech. So after the sales, Amazon will become a pure play for automation solution. The remainder, Amazon has an enterprise value about $44 billion at the stock price of $87 per share. Then its EV over EBITDA will be about 11.3. I consider that as cheap given the growth potential in automation solution in the years to come. Energy Transfer also reported a very strong quarter and gave a full year guidance of EBITDA around $12.9 billion. Compared to the guidance given at the beginning of this year of $12 billion, that's an increase of almost $1 billion. And that's almost as much as the $13 billion EBITDA achieved in last year, which included about a $2 billion contribution from the winter storm Uri. In other words, Energy Transfer's business is doing great. There are not many other changes to its guidance, except Energy Transfer raised its forward dividend again. So the annualized rate will be $3.3 billion, and that's up 72% from the same quarter last year. At a stock price around $12.8 per share, its forward dividend yield will be about 8.4%. In other words, raising the forward dividend has been supporting its stock price. So despite the more than 40% stock price increase in this year, its dividend yield is actually higher compared to 7.1 at the time when I did an update at the end of first quarter of this year. So if we add the capex expectation of 2 billion to 3.3 billion ongoing forward dividend, that's 5.3 billion. Then that's still significantly less than the this year's forecasted DCF, about $8.2 billion. So despite the Energy Transfer spent $500 million to buy Woodford Express, there will still be plenty of free cash flow left for either further dividend increase or stock buybacks. On the other hand, Bright Horizon reported a disappointing third quarter results. Its full service segment is slowly recovering, with a trailing 12-month revenue about 1.44 billion, still significantly less than 1.68 billion achieved in 2019. Its quarterly revenue growth was about 10% compared to 1 year ago. The reason I think it's disappointing was because of the margin. In the third quarter, its segment ops margin was actually negative 1%, was driven by wage and other inflations. As a result, I think that's also reflected in the company's gross margin of 24%. That's a dip compared to the first 2 quarters in this year. On the other hand, its backup care segment is doing very well with historically high revenue and 31% ops margin. In the third quarter, it generated EBITDA about $66 million and spent $225 million on capex and M&A. Interest payment was about $12 million and tax was about $9 million. The large capex and M&A expense was driven by the Only About Children acquisition. So at $68 per share, its enterprise value is about $5.3 billion. And the EV over EBITDA from 2019 is 14.5. That's reasonably cheap for a growth company. And looking at the risks and the opportunities I identified earlier, the risk of cannot find enough teachers to grow enrollment due to tight labor market has been an issue in the recent quarter. It also had trouble to timely pass wage inflation to become a higher tuition. On the other hand, it grew its high margin backup care due to its client relationship and scale. And in the third quarter, backup care was 24% of its total revenue. I haven't bought any Bright Horizons stock. I do plan to buy some when the valuation becomes more attractive, given that its third quarter results were not that strong, and I think there will be better entry point coming up in this year. There is no urgency for me to buy at the current stock price level. JFrog also reported very good Q3 results. So if we look at the quarterly revenue plotted on the top right, we can see fairly consistent revenue growth. It is a pretty remarkable growth. It is very consistent, and we see very little impact from the current interest rate environment. Its trailing 12-month net dollar retention rate is still high at 130%, with a high gross margin of 78%. Q4 outlook is strong, and duration to parity is 7.6 years at $23 per share. So can the faster growth continue? As I mentioned in the past, the focus for me is to look at its enterprise plus revenue. So in the past quarter, that segment revenue was 39% of overall revenue. That translates into $30 million in that quarter. And that's very remarkable considering the revenue in the third quarter of 2021, 1 year ago, was $18 million. That's a very fast growth. And the other revenue grew from $35 million in third quarter last year to 47. That's still pretty good growth as well, but just not as strong as the Enterprise Plus revenue. So with the Enterprise Plus subscription, it's become stickier and stickier for its customers, because we can see in this chart how many products its customers are using under the Enterprise Plus tier. Therefore, I believe JFrog is building a wider and wider moat. Similarly, Ingredient also delivered an excellent third quarter. Just quickly rewind to review the fourth quarter results from last year came out. Its gross margin was bad at 16.5%. The management blamed on high corn price inflation and other one-time issues. So we can see that in the 3 quarters of this year, the gross margin has been pretty good at 20% in Q1, 19% in second quarter, and 18.5% in the third quarter. And that's higher than 18.3% gross margin in the Q3 of last year, despite the high corn price inflation. And also, its quarterly revenue came in 19% higher on the constant currency basis. That's a very significant increase due to the pricing power, because Ingredient had no trouble to pass the high corn price to its customers, and in the same time protecting its gross margin. So that's why I think it's a very impressive business result. As a result, its adjusted operation income increased 23% compared to 1 year ago on constant currency basis. Because of these results, I can actually conclude that the Ingredient benefited from the inflation, and that's pretty rare in the companies I cover in my portfolio. My plan is to buy more Ingredient stock if it has a pullback. The last one I'm going to review today is Mercado Libre. Its unique active users in last quarter was 88.3 million users, up 12% from 1 year ago. And we can see the number in the prior 4 quarters. This is an important number to keep track, because Mercado Libre's moat is built on network effect. So the more users in its system, the stronger its moat will be. So similarly, in its fintech segment, the unique users were 41.6 million. That's up 32% year on year. And 72% of total payment volume is off platform in the most recent quarter, compared to 70% or lower in the previous 3 quarters. That also shows wide adoption of Mercado Libre's payment system of its e-commerce platform. That's also an indication of network effect and its widening moat. Its revenue in Q3 this year was $2.7 billion, comparing to $1.9 billion 1 year ago. That's a very impressive growth considering the economy has been reopening, and more activities were happening in the real world compared to online e-commerce. And also very impressively, its quarterly gross margin was over 50% compared to 43.4% 1 year ago. And 50% is higher than the second quarter of this year or the second quarter of last year. Because of World Cup soccer will be held in November and December of this year, and plus the Christmas holiday season, I expect a monster Q4 in terms of revenue. Its quarterly fintech segment revenue was $1.2 billion in third quarter. That's driven by fast payment volume growth, as shown in the chart on the top right. We can see that the acquiring TPV was $21.6 billion. That's almost double from $11.3 billion in the Q3 of 2020. More impressively, its digital account TPV was $10.6 billion. That's more than triple of the $3.3 billion from Q3 2020. As a reminder, acquiring TPV was a payment happening on Mercado Libre's commerce platform. At a high level, Mercado Libre is still growing its credit book significantly. So in the Q3 of this year, its credit portfolio was about $2.8 billion compared to $1.1 billion 1 year ago, and less than $300 million in the Q3 2020. However, sequentially, the $2.8 billion was not that much more than $2.7 billion credit book at the end of Q2 of this year. That's because of the deteriorating economic environment, and the management has become a little more cautious about extending credits. Because of the caution, the interest margin after losses shown at the bottom right has actually increased to $257 million compared to $225 million delivered in the Q2 of this year. Bad debt also declined to $285 million compared to $300 million in the second quarter of this year. So my takeaway is its payment system has been growing with more users and more payment volumes, and its credit side of the business has been more disciplined in terms of extending credit, and has increased its profitability as a result. That's why I think it had a very good quarter. So look at its valuation level. At $940 per share, its price over sales is about 5, and that's low compared to the valuation levels in last year due to its business has been growing fast, and its stock price actually suffered from the peak achieved 1 year ago. On the bottom left, you can see its commerce take rate in the most recent quarter was 17% compared to 16.7% 1 year ago. The biggest contribution came from the advertisement revenue. It was more than $110 million with 80% EBIT, very profitable. As a result, its take rate has increased both year-on-year as well as sequentially. Its fintech take rate in the recent quarter was 3.8% comparing to 3% 1 year ago. The biggest contribution came from the credit revenue. However, that take rate was lower than the second quarter take rate of 3.95%. I believe that reflects the caution in terms of extending credit I mentioned earlier. To summarize, there are some dark clouds in terms of economic conditions affecting Mercado Libre, but its underlying business is doing great. If its stock price suffered a significant pullback, then I will add to my current position in Mercado Libre. This concludes this episode of Quest for Twice. Until next time, happy investing.